Silver is being leaned on, psyoped to weigh on gold sentiment. This is how desperate they are. Precisely those synthetic interventions that are driving the current physical market tightness. No matter what the commodity, there will always be a buyer and a seller. And the equilibrium price is what naturally emerges. So you take out the 96% leveraged synthetic gold supply, and most liquidity providers estimate that the current equilibrium price of gold would be around that same percentage higher, $4,000 per ounce on a bad day. And in silver, at $4,000 gold, a real 16-to-1 ratio would put silver at $250 an ounce.
Gold and silver will remain focused this week, with crucial inflation data coming from the U.S. on Tuesday. Following gold's consecutive all-time highs last week, silver might emerge from its prolonged consolidation phase and begin to close the gap with the yellow this week. A rise towards $30 seems plausible. However, no significant obstacle prevents silver from reaching its peak at some stage this year. AndrewMaguire, independent London metals trader, is internationally renowned for his insights into the precious metals market. In this video, AndrewMaguire provides a detailed breakdown of the recent shifts in precious metal prices. Then, he delves into thoroughly exploring the depolarized silver market, uncovering its vulnerability. Maguire anticipates that gold would expose a $4,000 equilibrium price, while silver would reach $250 per ounce. Unveiling a narrative of market intricacies, Andrew mentions central bank manipulation in gold and silver markets to obstruct transparent price discovery. Allegations of silver price manipulation persist, fueled in part by the 2013 CFTC report and subsequent lawsuits against JPMorgan Chase. While skepticism exists among some market participants, the complexity of assessing manipulation claims in a transparent market requires careful scrutiny. While advancing his analysis, Andrew delves into the dynamics of silver's anticipated retracement, mentioning heightened delivery demands. Compared to last week, the price of silver is up 5.17%, and it's up 7.93% from 1 month ago. Global silver demand is forecast to reach 1.2 billion ounces in 2024, which, if achieved, would be the second highest level recorded. Stronger industrial offtake is a principal catalyst for the rising global demand for white metal, and the sector should hit a new annual high this year. Moreover, Andrew anticipates increased attention, with the COT report revealing a substantial $473 premium for repurchasing synthetic gold contracts. Now, we present the clips of AndrewMaguire's insights from his recent interview with Kinesis Money. Before we continue, please subscribe to our channel and activate the bell icon for timely updates.
So remember, gold and silver are foreign exchange crosses against the dollar and etc., pound, euro. And while central banks openly admit to interfering in the foreign exchange crosses, they refuse to answer questions related to foreign exchange gold and silver interventions. And although we've seen that recently with Mooney, we've seen that repeatedly, Gata doing some great work shaking this out, Powell refusing to answer those questions. Although gold is still somewhat impacted by these officially sanctioned position limit violations, this changed after gold was reclassified as a first-tier deliverable asset class on the 1st of January 2023. Now, gold is now ultimately deliverable, which limits the scale of interventions for precisely the exchange for physical loadout reasons we've just really outlined. However, as silver is not LCFR compliant, what we have been witnessing during 2024 trading began since the commencement of 2024 trading. Silver is being leaned on, psyoped to weigh on gold sentiment. This is how desperate they are. Now, the Fed intervenes in the foreign exchange gold and silver markets primarily because if they allowed an unencumbered real supply-demand price to be discovered versus the dollar in an open marketplace, it would expose the real inflationary inputs, which in turn would drive a further exit out of dollars to be exchanged for gold and silver. This is the battle that they're fighting, losing battle they're fighting. However, it's precisely those synthetic interventions that are driving the current physical market tightness. No matter what the commodity, there will always be a buyer and a seller. And the equilibrium price is what naturally emerges. So you take out the 96% leveraged synthetic gold supply, and most liquidity providers estimate that the current equilibrium price of gold would be around that same percentage higher, $4,000 per ounce on a bad day. And in silver, at $4,000 gold, a real 16-to-1 ratio would put silver at $250 an ounce. Silver's ultimately coiled for a very large retracement move, indicating this would commence into delivery demands, but be further capitalized on next week. It will be the inevitable coiling, physically driven gold rally that will force a full reversal of the naked short silver trade, ultimately tipping the balance for commercials, for CTAs to begin to reverse some more layers of their massively accrued naked short positions in silver. We're kind of running out of time here. I was going to go through the COT reports, but I think one of the most interesting things about the COT report we saw in silver, huge disparity in gold, literally that $4,730 per contract premium to buy back these synthetic contracts on Friday will have everyone's attention, and it will put the COMEX in the crosshairs for more central bank EFP delivery attacks.
AndrewMaguire points out vulnerability in the silver market, highlighting that $8,000 can control a 120,000 futures contract at the current price. He thinks the entry of physical buyers disrupts traditional price control through unbacked paper in the market. As per the recent circular from NSE and MCX, the initial margins for silver contracts have been revised from 10% to 13%, effective February 15, 2024. Furthermore, Andrew states a significant uptick, with 458 tons of COMEX deliveries and 130 tons from SLV ETFs in February. Contrary to initial market perceptions, he sees this as a bullish indicator. The active month of the COMEX silver futures contract was trading at $23.04 on December 12th. In early March 2024, the price was slightly lower. Let's get back to the interview.
Current silver prices at around plus or minus $24. All you need is $8,000 or just 6.7% to control each silver futures contract valued at $120,000. And given that 75% of the COMEX generated open interest is corralled in the hands of really a stampeding, led by the nose CTA herd who max out these position limits, but they never take delivery. Obviously, by never taking delivery. But because physical buyers have entered the fray, up until physical buyers entered the fray, it was easy to control the price, with the insiders loaning literally billions of dollars of unbacked paper open interest. We call them casino chips, to the herd. And insiders have been able to historically create what we just talked about, a defined wash and rinse cycle that both enrich them, but to also control sufficient open interest chips to create a synthetic silver price far below the 16-to-1 gold to silver ratio. Now, however, this is a classic case of pigs get fat, but hogs get slaughtered. The current refusal by the London professional trade, the cartel, to provide thousands of tons of silver to meet refinery orders has placed the crosshairs on this 93% leveraged COMEX Achilles heel, and leverage can work for you or against you. And while the cartel has historically been able to game this in their favor, greed has attracted a large enough, diverse group of wholesalers to secure their maximum 3,000 lots of COMEX synthetic silver and then to stand for delivery. And unlike any time since March 2020, this physical demand is sufficient to tip the balance against the cartel. And we don't even have a COVID panic this time. Liquidity providers confirm that a much larger, diverse group of traders are appearing, each one of them taking their limit of contracts. And they're appearing with the sole intention of taking delivery of extremely cheap COMEX silver. And while limited to just 3,000 lots each, these groups are swelling in size. And while dwarfed by the momentum CTAs driving over 75% of all the action, which is why you don't see it, it will be the forcing of delivery of these targeted contracts that of which is forcing this 93% unwind of synthetic open interest that is going to tip the balance. And this is just as we reported the effect of central banks forcing 96%. Remember, we talked about this last time. The central banks are forcing 96% deleveraging of COMEX, NSFR compliant, deliverable gold, and that, which has been attracting the central banks and sovereigns to do the same, and ultimately forcing the current breakout from the capped ranges. Really, what we did evidence at this point, though, was actually 458 tons of COMEX deliveries alongside about 130 tons of SLV ETFs during February. And now this has picked up significantly. So really, they were looking at that as weakness, when in fact, they were just misreading what was actually very, very bullish. And that was just February.
Patience pays off for gold and silver investors as analysts at TD Securities are closing their month-long tactical long positions for 7% gains. More importantly, with inflation on course to retreat towards the U.S. authorities' official long-term target, the Fed is expected to signal further and accelerated easing next year. The impact of falling real yields and pressure on the U.S. dollar should also favor fresh silver and gold investment. How will these factors collectively impact the future of precious metals? And what might be the implications for investors? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.